Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, one of the founding partners of the Dividend Kings marketplace service on the financial site Seeking Alpha. You know, we're obviously going through a really crazy market now. We're all aware of that. Stock prices have been jumping up and down every day, and of course the down days have been frightening and scary. All of this, or most of it, related to the coronavirus and then exasperated by the plunging oil prices and the argument between OPEC and the Russians. So there's been a lot of uncertainty in the market, a lot of risk going on, a lot of volatility. Now, that's in some ways could be considered a bad thing, but I think you could also look at it from a different perspective and consider it a good thing. For example, as a dividend growth investor primarily today, and I write to a lot of my articles for the dividend growth investing set, the creme de la creme of dividend growth stocks are the Dividend Aristocrats. This is a group of 64 companies that Standard & Poor's reports on, and these are companies that have increased their dividends for 25 consecutive years or longer. And it's a very obviously a list of really blue chip dividend growth stocks. So if dividend growth investing is really what you're interested in, then there's no better place to look than the Dividend Aristocrat list. However, when you consider the low interest rate environment we've had now for several years, and the fact that you can't get much in the way of fixed income, these Dividend Aristocrats have become high quality dividend growth stocks, have become attractive to the point where people have bid their prices up. So valuations have been very, very high on the overall Dividend Aristocrats list. To illustrate my point, let's go into the preloaded portfolios for premium subscribers to FastGraph, and let's look at the 64 Dividend Aristocrats as reported and kept by Standard & Poor's. And what I'm looking at here is I'm primarily looking at earnings yield and PE ratios. Now, I like an earnings yield of at least 6.5 or 7% because the earnings yield is the inverse of the PE. Instead of price divided by earnings, it's earnings divided by price, and it tells you how much the profits of all the profits of the company would be paying you as an investor if you were to receive 100% of them. So to me, when you're looking at very high PE valuations, like for example, you're looking at Clorox with a PE of 28, well, that's only an earnings yield of 3.5%. That's hardly enough, return, if you will, to compensate you for the risk. But if I look at these earnings yields, I'm looking for that 6.5 to 7% or higher range. Now, as far as compiling the list that I'm going to be covering in this video, I did 6% because I'm giving a quality premium to some companies. But you can see how far deep I'm going into this list of 24 companies before I start seeing 6% rates of return. Now, another thing that I looked for was also highest quality. Because of the uncertainty in today's market, I only wanted stocks that were rated A or better. And again, you'll see that part of what's happened here, the good news is that this recent quote-unquote bad market environment we've been in, choppy market environment we've been in, have brought a lot of these stocks that have been highly valued back into fair valuation territory. Consequently, I thought it would be interesting and fun for y'all for me to take a look at and try to find what I would consider to be my top 10 Dividend Aristocrats that have credit ratings of A-rated or better and earnings yield above 6%. Now you can see that if I put these in order of earnings yield, the lowest earnings yield is 3M, which I'll show you in a moment, at about 6.25%. This is typically a premium valuation company, and the earnings yields go all the way up to 11.76%. These companies have dividend yields ranging from 2% to over 5%. Abbvie is the highest yielding in this group at 5.54%. So I've listed quality, I've listed valuation, and I've looked for dividend yield here. And what I'm going to do is I'm going to cover these companies in alphabetical order just to make it simple. And what I'm going to start out doing is just looking at adjusted operating earnings for each of these companies. And these are non-GAAP numbers. These are the numbers you usually get in the press releases. And what I'm looking for is valuation. The orange line on most of these graphs will be a PE ratio of 15. And, when the stock price is trading below that, it's attractive. As you can see with Abbvie, which was spun off from Abbott Labs back in 2012, it's historically, the price has hovered around that 15-ish PE. The blue line here is a 13.79. And you can see recently the price has gotten extremely low, which means we now have an earnings yield of 10.65% and a dividend yield of 5.54%, and we can buy this stock at a 5.39 PE. So if I look at this from a forecasting forecasting perspective, and I like to only go out a couple of years here, this could generate some really attractive returns, 44% annualized over the next year and a half or so, assuming the stock did earn what the analysts, there's 7 analysts forecasting it to earn on operating earnings, and assuming it goes back to a normal PE. However, if it trades at the low multiple that it's currently trading at, which is about a 10 PE, you still have a 20% potential rate of return from this company with a nice 5% dividend yield. So it looks very, very attractive. And what I'm going to do here is I'm going to first go through all of these companies, just looking at valuation from a standpoint of adjusted operating earnings. Then I'm going to come back and look at each of them from an operating cash flow and a free cash flow, with the idea that I'm looking for dividend coverage when I'm using those cash flow metrics. So I'm going to start out with Aflac, and I want to make a point here about this company. I've got that 15 PE ratio line, which Aflac did trade at prior to the financial debacle, but since this is a financial, I do want you to notice in recent years the market's been valuing this stock at somewhere around a 10 to 12 PE. The blue line on this graph is an 11 PE. But even by using that lower standard, this stock is extremely inexpensive now with a blended PE of 8.5, an earnings yield of 11.76%, and it's really getting close to a 3.3% dividend yield at 2.98. It's an A- rated company with only 18% debt to capital. So I think Aflac looks very, very attractive here. From a forecasting point of view, you can see if it gets back to a 15 PE ratio, there's a lot of upside. The stock that can be bought today at 37 could be worth by 2022 $72 a share, and by 2021 $69 a share. So I consider Aflac very attractive at these levels. My next research candidate here, and these are all research candidates, companies that you can look into yourself, is Caterpillar. And I want you to notice Caterpillar's earnings are cyclical, but I do want you to notice that the company's stock price tracks the movements in earnings. It goes up when the earnings are growing, and it tends to get weak when earnings are weak, and vice versa. But right now, we've got it trading at a very low valuation, blended PE of 9.7, earnings yield of 10.3, and we're just under a 4% dividend yield right now, which is very attractive. The company's A-rated with 50% debt to capital. And again, you can see I've got some really nice potential price appreciation, assuming this trades at a normal or a fair value PE of 15. So Caterpillar looks very attractive here. The next company I'm going to look at is Chubb, and Chubb is a property and casualty insurance company, so it's analogous to Aflac. I do want you to notice that this company for the last several years has been trading at higher multiples, but like Aflac, it's also historically been trading at a 10 multiple. So I want you to take that into consideration. If it were to trade at this lower multiple that I've got on here, you would still have an opportunity to make double-digit returns. I'm using a 13 multiple here. If it traded at a 10 multiple, you'd obviously not be able to make any money on it, but it does offer a 2.2% dividend yield. It's A-rated with only 19% debt. This might be the one company in this group, or one of two companies in this group, that I might wait on. The next company I want to look at is Emerson Electric. This is a company I've admired for many, many years. The market does tend to put a premium valuation on this particular stock in contrast to what we saw with a couple of financials we've looked at. It's A-rated with only 29% debt. I can get this almost at a 4% yield now, an earnings yield of 7.29 and a blended PE of 17.71. That was as of yesterday's close. When I look at this stock from a forecasting point of view, using the normal PE, the rates of return over the next couple of years would be very attractive. If I look at it at a more conservative 15 PE, it would still be the potential to earn double-digit rates of return. You can see this is a very opportunistic time to be investing in Emerson Electric, an extremely high-quality electrical products company. My next candidate is one I've covered in recent articles. It's the defense company General Dynamics. And, I've talked about this as a lesson in valuation. You can see how undervalued it was back coming out of the Great Recession and when we had defense spending issues or, cuts in defense spending. As that has resolved itself, we saw a point where the company got very overvalued. It then came back into fair value, which is when I started mentioning it. And now, thanks to this correction, it's fallen to undervalued territory, PE of about 12.39, earnings yield of 8%, and a dividend yield of 2.9%. So I would consider General Dynamics very, very attractive based on operating earnings at these levels. The next company is another one that's very, very hard, like similar to what we saw with Emerson Electric. The market tends to put a premium valuation on Grainger, which is a wholesale distributor. It's A+ rated, has 48% debt. It's available at a sub 15 PE for one of the few times that I've seen it, notwithstanding the Great Recession. Earnings yield's about 6.8%, dividend yield about 2.25. And again, we've got some really nice capital appreciation potential with this company going forward. So Grainger's another one of these high-quality dividend aristocrats. Remember, all these companies have increased their dividend by 25 consecutive years or longer. And the next one is 3M. 3M is another company that the market likes to pay a premium valuation to. It was pretty excessively overvalued in 2018. It corrected dramatically. It did have a down year in 2019, which brought the price back into more reasonable valuations. It trades at a 16 PE, only has a 6.25% earnings yield, but given the premium valuation the market normally applies to this A+ rated company with 58% debt, this is one of the few times you could have added 3M to your portfolio in several years, other than notwithstanding the Great Recession in a couple of years following it. So, it's been several years since we've had a chance to buy this stock, but it looks very, very attractive today. The next one is the old Pittsburg Plate and Glass. It's an industrial company, or it's now called PPG Industries. Again, we see a penchant for the market putting a premium valuation. It's come down to a PE just above 15, an earnings yield of about 6.46, a dividend yield of 2.9. It's A- rated with 46% debt. This is, again, a rare opportunity to buy this company at what I would call a rational valuation. And then last but not least, we're going to take a look at Stanley Black & Decker, also A-rated, 24% debt. You can see that the stock has had pretty high valuations over the most recent years, but now the market's brought it down to a PE ratio of 14.1, earnings yield of 7.8, dividend yield 2.3. The company's A-rated with only 24% debt. So these are all very attractive dividend growth stocks. Now, what I'm going to do here now, I'm going to switch and look at dividend coverage. We've looked at these companies from a standpoint of valuation based on earnings. What I would like to do now is move on to what I call dividend coverage. I'm going to do that by looking at operating cash flows and free cash flows. Now, I'm going to take price off of the graph and anything related to price, like the normal PE. So I'm not really as concerned about valuation, or you can use operating cash flow as a valuation reference. I'm looking at, is the dividend covered? Does the company have more cash flow than they are paying in dividends? It's a real simple equation. And, in the case of ABBV, that's very clear that they do. And then when I finally go into free cash flow, which is what's left over after what the company spends to run the business, I also see that ABBV has free cash flow coverage that's greater than the actual dividend. It got pretty close in 2014, but otherwise it's been covering the dividend very nicely. Remember now, this is a spin-off from Abbott Labs. It doesn't have the long historical record on the fast graphs here because part of that was attached to Abbott Labs. When I look at Aflac, I'm looking at free cash flow here. Everybody knows Aflac by the duck. Free cash flow is covering the dividend by orders of magnitude. Here we've got $7 of free cash flow, ish, and a dividend of around $1. So, it's covering it by 6 point something to 1. If I go back to the operating cash flow metric, just to make this video move a little more smoother, you'll also see that, operating cash flow is also significantly greater than the dividend. So this is a very attractive company from a standpoint of dividend safety and dividend coverage, at least in my humble opinion. Caterpillar, even though it's a very cyclical company, also has operating cash flow substantially covering their dividend, as we see here. When I move this one into free cash flow, you'll notice that because it is a cyclical company, there are some periods where free cash flow did not cover the dividend. But again, they had ample operating cash flow, and when they did have negative free cash flow, they usually recovered dramatically. And I think that's simply related to the cyclical nature of the stock. When we go back and look at Chubb, which again is a financial, as I mentioned, and I look at free cash flow. This is since the Great Recession. Free cash flow covers the dividend by 4, 5, or 6 times, as you can see. When I also then look at operating cash flow, free cash flow being the asset test. Some of these I'm doing backward just to make it quicker to move through the video here. When I look at operating cash flow, it substantially covers the dividend. They got, $13 and $16 of operating cash flow in 2018 and 19, and they're paying a dividend at $2 and $2.98. So great dividend coverage. Emerson Electric, the high quality stock that I said you rarely get a chance to buy, also has operating cash flow significantly covering the dividend. What I'm really getting at here, ladies and gentlemen, when I'm showing you this, is these are companies that I believe are worthy of additional research and due diligence on your part. Free cash flows covering the dividend on Emerson Electric. I've already shown that the prices of these stocks are inexpensive today. The idea here is these are worth doing some more due diligence and research on. General Dynamics, free cash flow covers the dividend dramatically. And of course, obviously, if we got free cash flow covering the dividend, then certainly we're going to have operating cash flow covering the dividend. Moving on to Grainger. Once again, we see tremendous operating cash flow coverage of the dividend. And then if I go into free cash flow, we also once again see that the dividend is very safe, and free cash flow is expected by the consensus of analysts following the company to grow dramatically over the forthcoming years. So I would consider this a very attractive research candidate for a total return potential. I'm going to go back to 3M here. 3M has free cash flow coverage of their dividend, and of course, if they have free cash flow coverage, then they're going to have operating cash flow coverage, which they have tremendous coverage of the dividend. I consider the dividend very, very safe for this A+ rated company. When I look at PPG Industries, I'm going to start with operating cash flow here, and you can see that operating cash flow is significantly higher than the dividend that they are paying. And then likewise, when we look at free cash flow to see if we got dividend coverage, it got pretty close coming into the recession, but otherwise free cash flow has been, covering the dividend by orders of magnitude, or by at least a substantial amount. Stanley Black & Decker, last but not least, free cash flow did fall short of the dividend in 2017, but it recovered very, very strongly. But from a standpoint of operating cash flow, we see that operating cash flow has amply covered the dividend even in 2017 when they were kind of light on free cash flow. Now, in order to close this video and summarize, I want to go back to the portfolio review where I've put these into a portfolio. And I'm looking here at estimated earnings growth and the total rate of return that those earnings would indicate. And, the lowest potential return is one of the highest quality companies here, A+ rated 3M, with a 9% annualized rate of return out for the next 2 years. And then, of course, every other company in this list has rates of return that would exceed double-digit rates, or that are 10% or higher. Now, the highest would be Aflac, but that assumes that it moves back to a 15 PE. If you assumed, that it traded at that lower multiple that it's been currently trading at, it would be less than that, but still very substantial. So here's a group of extremely high quality, all A-rated or better companies that have, good histories. They have great cash flow coverage of their dividend, and they all are trading at valuations that are very, very attractive, offering earnings yields that are above what the market offers you today. Anyway, this has been Chuck Carver. I hope you enjoyed this. These are 10 stocks that, if you're a dividend growth investor, I think are worth checking out and looking at deeper. If you liked what you saw here and, you're interested in learning more or seeing more videos like this, please subscribe to our YouTube channel. We would really appreciate it. It's currently free, and there's a lot of videos like this on individual companies as well as groups of companies. Anyway, thanks for watching. I hope you're able to survive this market correction and take advantage of the opportunities that it's bringing us. Thanks for watching.